feeling a bit overwhelmed by all the conflicting information about Australia's housing markets? Well, you're not alone. Welcome to this week's episode of the Michael Yardney podcast, where I'm going to help you work through some of the conflicting, confusing messages and work out whether it's a crisis or an opportunity. You see, a short while ago, Ken Race, Director of Metropole Wealth Advisory, and I conducted a webinar, and even though there were well over 1,500 people registered for the webinar, I know the audience to this podcast considerably more than that, and so therefore I wanted to share it with you as well. Now, sure, on the webinar there were slides, and we talk a little bit about those, obviously, but I don't think you need to see them to get the main gist of the conversation with Ken and me, but I will in the show notes leave you a link to where you can watch the replay and see the slides if you want. So we are going to talk about, is this a crisis or an opportunity? I'm going to unpack the key factors shaping the current housing markets and where there will be opportunities to thrive. We're going to talk about some proven strategies for making sound investments, even when the market is unpredictable. We're going to talk a bit about protecting your investments and give you some predictions about where our housing markets are going to be in 3 years' time. So rather than making decisions based on fear-mongering, have a listen to Ken and me, and let's get on with the show so you can make some evidence-based investment decisions.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome, and thanks for joining us at today's masterclass, where I'm joined by Ken Race, Director of Metropole Wealth Advisory. Hello, Ken.
Hi, Michael. Hi, everyone.
Now, we've got hundreds of people joining us this afternoon, Ken. We've got lots to discuss because at the moment there's a bit of concern. There's lots of challenges in the market at the moment and the economy, and it's making people wonder, what should they do? Is it the right time to buy, to sell, to get out? Every time we think we've got it sorted out, something changes, Ken.
That's right. And a lot of the new clients that I'm seeing, it's this quandary. What do I do? Is the market going to change? And when you talk to clients who've been in that market for, call it 20 to 30 years, you can actually dig out of them that in reality, they've been through similar times a few times before.
Yes.
That this is not necessarily anything new. It might be a little bit worse, a little bit better, but markets are cycles and they go up and down. We have recessions, not that we're in one now other than a per capita. We have high interest rates, we have low interest rates, high migration, low migration. So I think the skill of a savvy investor is to understand and appreciate the market and how to use that to their advantage.
I think that's a really good point. Now, guys, we've got a lot to cover. We can't cover everything. We're going to give you an hour, but we also want to help you by answering your questions. So first of all, just put in the chat there that you can hear us. This is always funny because Ken's in Sydney, I'm in Melbourne. There's hundreds of people online already all over the world, or all over Australia. So just let me know that you're there. And then if you can, please, if you've got any questions along the way, please just put something in the chat and Ken and I will help you with that as well. So let's start off. There we go. People's names are coming. There's a little bit of a lag, but everything seems to be working. Hi, John. Hi, Wayne. I'd like to start off by just giving some context to where we are in the housing markets at the moment. And then the next thing is we'll have a talk about what all that means. So the latest CoreLogic figures came out couple of days ago at the end of May, and what they show is that the housing markets have been increasing in Australia for 17 months in a row now. Now, they're very fragmented, and as you can see here, if you take into account what's happening. They're showing here total returns with regard to rent and capital growth. But overall, the markets are still moving up, but a little bit more slowly than they did last year. If we actually have a look at this, you can see what's happened in the last month, the last 3 months, the last 12 months, and there have been some real winners, with Perth going up 22% over the last year, and Queensland going up 16%, Adelaide 14%, and poor little Melbourne, where we are, has grown 1.8%, Sydney 7.4%. We will talk about that in a moment. Remember, there isn't one Melbourne, one Sydney, one Perth property market. So really, the opportunity to outperform the markets is one of the great things I like about property. But if you have a look at these charts here, you'll see what's happened. And if you, on the right-hand side, just have a look at where we are compared to the peak. This is what's happened through the recent cycle, when the suggestion was that this got reset in March 2020 when COVID started. Believe it or not, Ken, that was 4 years ago now. We had ultra-low interest rates. We had a once-in-a-generation property boom that anyone who could buy any property anywhere got significant capital growth, then a period of lower values. You can see in the chart there how everything went down in 2022, and then things started to pick up again at the beginning of 2023. But Sydney's only sort of back to its peak of 2022. Melbourne is still below its peak where it was before, and there's a couple of cities now at new peaks, including Brisbane, Adelaide and Perth. What's created this significant property growth is a combination of things. The underlying demand related to very significant population growth. As you can see in the bottom chart there, Australia's population grew very, very strongly. But one of the big things that the census has shown is that we used to have 2.8 people per household, and now it's about 2.4, 2.5. That doesn't sound like a lot of difference, but if you think about it, it's actually 10% difference, and that means that for the same number of people, we need 1 million more houses. And that's unlikely to change. There's more 1 and 2 people households. There's people downsizing. There's baby boomers dying off. There's young families getting into the market. So, Ken, the size of the average household is very different to what it was when you and I first started investing.
That's right. And I think also the makeup of who's in that property is changing. It's not just a family, joined by blood, so to speak. People are co-sharing. So those whole demographics have changed. And while you used to have, homes with 20 students in there, the census at the moment, it's consensus, not census, is those sorts of people don't want to live with 20 other people in a party house anymore.
Yeah.
So even the student accommodation, when people are sharing, those numbers are dwindling down as well.
Sure. So if you look at our population, there's about 27 million people in Australia. That makes about 11 million households. And the average number of people, as I said, has kept dropping. But interestingly, the other change is that the share of people working from home is much greater now than before. If you have a look in the past, it was a decade ago, about a third of people, 30% of people, worked at home 1 or 2 days a week. This is coming from the Australian Bureau of Statistics. Obviously, over COVID, a larger percentage of people worked from home, but things have changed. I'm working from home. Ken works from home a couple of days a week. So more people are working from home for some time. And on that basis, that means we need bigger homes. Working from Zoom on a kitchen table doesn't cut it anymore with kids and animals walking through. The other big thing is also millennials are now coming to household formation age, so they're looking for bigger homes as well. When they choose to get a home, they're looking at something for the child or upcoming children, as well as a Zoom room. So the sort of accommodation we're looking for has changed too, Ken.
Quite so. And I'm seeing anecdotally, it's quite funny, young families, that one of the breadwinners is actually going to work more days and not staying at home maybe with the screaming child. So there's a bit of a mix there that people are wanting to work from home, but depending on the circumstances, a newborn child, whatever, that it's forcing people to go back to the office a bit more than they would have liked. But when they're at home, they do need that peace and quiet, and therefore that's changed the type of property, what people want, which is why we saw the gap, if you like, between house prices and unit prices diverge so much, particularly through COVID and the other end.
Yes. Well, clearly we're having a housing shortage at the moment, but having been around property now for, well, over 50 years, I know housing supply eventually does catch up. It does respond to this growing demand. The thing that changes each cycle, and Ken and I have been through quite a few, is the speed and the magnitude of the response. That can vary, and it's determined really by rentals and by house prices, underlying construction cost, and the time it takes to design and approve new buildings. And until prices and rentals adjust to make the new developments financially viable, developers aren't going to take the risk. So the extent of how long it takes to go through each cycle has varied from time to time. But even if prices do pick up, and they will eventually, they have to move to the next cycle, the new developments don't come out of the ground straight away. It takes 10 months or so to build a house. It takes a number of years to build all those medium density and high density dwellings that the government's wanting us to have. And what this means, Ken, in my mind, is that there's no shortage, there's no way this rental shortage and house for sale shortage is going to go away anytime soon.
I think that's right. And I mean, we see the headlines at the moment that there's a housing shortage predominantly driven by migration. But if you sort of take a few years during COVID where we had basically no migration, this is a catch up. So that demand would have been there. So I think that the two things have changed. We've had a turbocharge in a small period of time, but that should even out. But the big difference, I think, is that we've gone from, I think, that 2.8 to 2.5 people per household, which is an extra million houses that needs to be built. That's fundamental change. The other fundamental change is the long-term average of migration has gone up. So if you even it out, and, you know, the governments are talking about dropping it, not dropping it. But if we go from, 180,000 as a normalized number for migration to 240, that's 60,000. At 2.5 per house, that's over 20,000. And that represents more than 10% of new dwellings.
Interesting. If you think about it, there's going to be 1 million more people in Australia in the next 3 years, and then 1 million more people in the 3 years after that, and 1 million more people in the 3 years after that. The numbers are mind-boggling, Ken.
That's right. And it's been very lazy, if I can sort of put it that way, for governments to, I think, turn a blind eye to things like infrastructure and the like, councils, red tapes, green tapes, and that's all making it harder. The banks, therefore, are a little bit more shy about lending. So I think it's going to be more of the same, but at a gradual worsening because of those two factors, that migration levels as a base level has gone up and households and number of people per households have come down.
What this particular chart's showing is also the capacity to pay has become difficult, because we know that house prices have increased considerably more than wages have over the last years. And so that's creating a challenge for first home buyers to get into the market, especially since they've got to pay more rent, especially since their cost of living has gone up, especially because they need more of a deposit. But interestingly, that's where the Bank of Mum and Dad comes in. Over the last quarter of 2023, PEXO, that do all the conveyancing, showed that a third of all transactions on the east coast of Australia, in Melbourne, Sydney and Brisbane, were done with no mortgage involved, Ken.
No mortgage, yeah. That number's just steadily grown.
And that's really related to baby boomers right sizing and also people buying holiday homes. They thought it's not as much the bank of mum and dad there because they don't usually buy the whole house outright. But I guess when we're talking about a housing crisis, it's affecting some, but there's clearly a whole segment of the market that it's not affecting at all. This is showing home constructions versus population growth, a chart given to us by AMP, and it's basically showing the significant shortage of properties we've got. The blue line is the annual population growth, and you can see the curve there that Ken initially mentioned of a huge surge the year before last and last year, basically because we didn't have any students for a couple of years. And normally there's the people leaving the country, people coming into the country. And what happened was there weren't any students finishing their 3 and 4 year university degrees, only people coming in. So the net migration was very high. But there currently is nowhere near enough properties being built. So this is a slide showing that there is a significant undersupply, and that's going to remain for a while. There are various people organisations that have estimated the undersupply, but Ken, the suggestion is currently, even as a starting point, we probably need 100,000 more dwellings just to break even, to create sufficient supply and to get a nice, comfortable supply and demand ratio. And that's got nothing to do with building more dwellings for all the people coming.
That's right. And my personal view is that probably is understated. I mean, when you look at what our capacity in Australia is to build, it's only about the 170, 180. And funnily enough, 30 years ago when I looked at this, when I used to work for a very large Australian building material company, we were only building 180,000. So 30 years ago, we're building the same number of houses
as today. Population in Australia.
Correct. So this is now, we're finally starting to see the pain of the last 20 years. I don't know that it's going to get better sooner. We need, I think, more density, and then that creates problems with getting approvals. How far up can you get? The not in my backyard syndrome. But I think Australians are slowly, more and more in acceptance of unit dwelling as opposed to house dwelling.
Yep.
Because a lot of them have got, I think, overseas influences in them. And certainly overseas, it's not frowned upon to live in a high-rise apartment or a middle high-rise.
No. So it's showing the undersupply. And that's showing up in a couple of areas, including a very, very low vacancy rate. Vacancies at historic lows. I've never seen them that low. It's suggested that to have a comfortable market where there's enough accommodation for potential tenants, the vacancy rate should be around 2%. But what this is showing is that the vacancy rate is in many areas below 1%. Rents actually haven't kept up with the CPI either. So that's a little bit confusing, that chart, because 1 is at the top there and 5 is down the bottom, and it's the other way around on the left-hand scale. But the vacancy rate on this chart shows that it's less than 1%. We know that as long as there's a reasonable rent put on it, any property we manage at Metropole in our offices in Melbourne, Sydney, Brisbane get leased straight away. Rents have not kept up with the CPI. This is not nasty, greedy landlords catching up, because landlords, unfortunately, also have had very significant costs imposed on them, mortgages, compliance costs, detector inspector, bringing properties up to standard. So I can't see this getting better anytime soon, because if you look at the pipeline of constructions, dwelling approvals are very, very low, particularly higher density dwellings. It peaked around 2016 approval of new high-rise apartments. They've all come out of the ground. They've all been built, and there's very little new in the pipeline. And those that have been approved will not necessarily come out of the ground because they're not financially viable, but we're just not building enough properties, and there's not enough in the pipeline. Now, we know that Anthony Albanese government realises there's a housing problem. They've talked about it. They realise that it's a historic underinvestment of property. So they said, we want to build 1.2 million new dwellings in the next 5 years. And in the budget, they gave a couple of extra incentives for that to happen. They're not going to build any of those. Private investors, mums and dads, and that's a bad term, but ordinary Australians, as well as corporations, as well as now with the build to rent overseas, companies are likely to be building those, but they're not going to build them if they're not financially viable, especially the overseas corporations and the companies. So all these in the pipeline won't get started until they can sell them off the plan. Remember the last boom, Ken? It was mainly overseas investors who underpinned a lot of the purchases of the high-rise buildings that were leased to Australians, even though they're bought by overseas people. At the moment, there's huge disincentives for overseas developers to do something and for overseas investors to buy anything here.
And in fact, I don't like to say it this way, but the foreign buyer, if you like, was almost a godsend.
Yes.
Because that allowed the developer to get to a level of pre-sales.
Yes.
That then allowed him to build a building for the ordinary Australian, for want of a better term, to buy the remainder. So as that market has shrunk for a number of reasons, as you said, the tax incentives, the land tax, the stamp duty, imposts have just made it horrendously expensive for a foreigner to buy. That's one of the reasons that there's less of these high-rise. Because foreigners can't buy other than in very, very strict guidelines. They're not allowed to buy an existing property. It's got to be new. It's got to add to the stock.
Yeah, I'm comfortable with that, to add to the stock. The problem was that last round of big developments were built very poorly as well. So they didn't have good floor plans, which the overseas investors didn't understand. They have different criteria to us. They were looking to get their money into a safe haven, very different to the local Australian investors. But more than that, though, we know about the troubles with our Opal Towers and Mascot Towers. And so that's made a lot of Australians very wary of buying into high-rise properties, and they've realised that with off the plan, all the incentives that the marketers get are built into the cost, so it's very rare to make any money out of those. So there's the foreign investors who are staying away and local investors who are not underpinning it. So the bottom line is developers need to make Harry Truggerboff actually need to have significant pre-sales. Now, this is an interesting chart that shows that Australia has fewer dwellings per 1,000 people than the OECD average. So Australia has got about 420 dwellings for every 1,000 people in 2022 when this chart was done. And this lags behind comparable countries like Canada, the US, the UK, which are also interestingly below the OECD averages, but we just don't have enough accommodation per 1,000 people, or what, for people in general. And this is suggesting that the lack of supply is not going to go away anytime soon, which really means that it's going to be harder to buy and harder to rent for quite some time. So this is what's happened to dwelling values relative to incomes. As we've shown already, they've actually risen substantially, making it a bit harder. And it's showing the income required to service a new mortgage at median values. Now, this is interesting. The media loves this, and a particular party with a green colour likes to come up and say all these terrible things that are happening. So, yes, it costs 58% of the median income in Sydney to buy the median house in Sydney. That's a way of fiddling with figures, though, Ken, isn't it?
That's right. It's the average on an average, and that's why Darwin looks so low. You know, their house prices are relatively similar, as we saw from a few other slides, not quite as high as Sydney, but the median wage, because of the proportion of people working in the energy sector in Darwin, the FIFO, the fly-ins, fly-outs, is so high that they've got the money there to pay for those properties, and that's why Darwin looks low, not because it is low.
Interesting. Now, guys, thank you for leaving your comments. I can see that Rapul can hear me really clearly from South Africa, so I don't know why somebody didn't hear me from Bay Street, Brighton, which is just down the road, one of our team members. And thank you, David Land from Northern China. That's fascinating. We've got people from all around. So the time to save a deposit is taking longer, and people are having to stay in rental accommodation for longer, which is getting more expensive as well.
Just on that, Michael, I think that's where the bank of mum and dad or grandfather and grandmother comes in, because at the low interest rates, the cost of covering a high loan is, not that much different than, when I bought my first property sort of 45, 50 years ago at 17% interest rates. But the big issue in the last few years has been, how do you save for that deposit? So
Yes.
If you can get someone to help you save for that deposit, then I think the repayments, that's a completely different question.
It really is the case, Ken, that it's not the mortgage serviceability.
Yeah.
It's actually the saving for a deposit. Now, interestingly, in a couple of days' time, you and I are recording a podcast on how to help your children get in the market. So if you're listening to this and you've got kids and you're worried about that, watch out for the Michael Yardney podcast, where Ken and I are going to discuss that. But also, if you're wanting to get into the markets, there's going to be some great suggestions for you as well there. This chart basically shows what's happened to consumer sentiment. And you can see over the years, sentiment hasn't been as low as this, other than in the recession of the late 80s and even the global financial crisis at the beginning of COVID. We weren't as down for as long. Ken, sorry, every time we think things are sorted out, there's another bogeyman that comes around from around the corner to scare us.
That's right. That's why one of the fundamentals of owning property is having that safety net, that buffer. Because, as night follows day or the other way around, there will be hiccups. So how are you going to fund your way through those hiccups? And that's all about being an astute, smart investor, where it's not just the property I'm buying, I'm actually buying my safety net as well and having that in place.
So consumer sentiment is very low, and the media loves playing on that as well, don't they?
They certainly do. I mean, there's no good news unless it's bad news or something like that.
That's right.
Bad news sells a newspaper and makes a headline.
I guess that's an important factor to understand, that the media's job is not to educate you. It's to entertain you and get your eyes on the pages, because most people look at it online nowadays, where they've already had advertising paid for. So whether it's a hard copy newspaper or online. So therefore, we both give a lot of commentary to the media, and we understand how they work and what drives them. Interestingly, this current chart is showing that other than after the First World War, as a proportion of the population in Australia, immigration hasn't been as high. Now, a couple of times we've explained why that is. There was that one-off catch-up after COVID, but there was the budget, and then there was our opposition leader, who I think started his election campaign and his budget response, and they're saying they're going to drop immigration. Ken, that concerns me. We need the immigrants coming in. Now, we also need the housing for it. I don't think stopping immigration is going to solve the problems. But what's your feeling about cutting back on the immigration?
Look, I think there's a difference between cutting back the underlying number you're going to be bringing in year to year, and that worries me, because we do need the skilled labour, because it's going to take a number of years to get people through TAFE or whatever, go through apprenticeships, get a couple of years under their belt. Mm-hmm. So the problem is, when you look at now the paper on migration, the people that they're giving, if you like, easier access to the migration aren't the bricklayers and the plumbers and carpenters. They're people in ancillary areas that, while they're needed, they don't fill the big gap of the tradesperson, which is what we're going to need if we're going to build these 240,000 dwellings a year That's the 1.2 million that the current ALP government wants to do. So we need a two-pronged attack. You need migration to fill the gap over the next 4, 5, 6 years while you train new apprentices, get them to work in the on properties, on building, get a couple of years of skill under their belt, so to speak. I don't believe in the levels of migration at 400,000 or 500,000. I see it as an aberration to catch up. The big issue then is on student migration, where we're actively seeking students to fill the universities. That makes money. But the road from a student visa to a permanent resident visa is pretty easy nowadays. So they're the ones that then, if you like, end up staying here and arbitrarily pushing up those numbers over time.
Well, we're needing to replace the baby boomers, and all the baby boomers will retire over the next decade. The other thing is millennials are now at household formation age, baby formation age. So many of them are going to, even if it's for a year or so, pop out of the workforce as well. So that's another factor that we're going to have to replace some of those. And there are many jobs that the locals aren't wanting to do. That's why you and I spent a bit of time with Simon Kirstenmacher, who helps with pointing out to us where the demographic trends and where the gaps are going to be. I can remember it wasn't that long ago that there were signs up in all the restaurants and all the cafes. Baristas wanted wait help, wanted that. Of course, that was when the students weren't there. So we need people at the knowledge base level, the people doing regular jobs, and I'm not belittling them by saying that, and even the students. Interestingly, our third or fourth biggest export is education. If you think about it, Australia can only do 4 things, so it's actually the third biggest export. We grow things in the ground, and we sell those food. We dig things up out of the ground and sell them. That's the minerals. We have huge education, people coming in and bringing dollars from overseas, A, for the universities, but B, when they come here, they've got to buy a television and they've got to buy clothes and the latest phone and all that. They grease the wheels of industry. And we are able to provide education for our kids and our grandkids because the universities are subsidised by these very high fee-paying students. If we cut them out, as Peter Dutton was suggesting in his budget response, the money's going to have to come from somewhere to keep the universities up, and the government hasn't got any more. Students can't afford to pay more and take higher HECS. So what that's going to mean is we're not going to be doing as much research. We won't have as much academia. We need the foreign students, Ken.
We do, but we also need, as part of this bigger topic we've just been talking about, is people to fill those jobs.
Yes.
And I think one of the untapped sources, if I can put it this way, it's the grey nomads. So people who are retired, who are on Social Security, Centrelink payments, that they actually can't afford to go back to work 2 days a week, to keep their sanity, to earn a bit of money, because they're potentially losing 50 cents in the dollar of their Centrelink payments. So the fix, if you like, is much larger than, the migration question. We need to look at governments. We need to look at how people are taxed. We need to look at minimum hours, dollars earned. As the population ages, if I can, crudely put it, dementia issues will increase. And if you keep people in the workforce longer, they're active. Who am I?
What are we doing here, Ken?
Yeah, it's sanity. So I think there's a number of reasons to get a portion of people who have exited the workforce back in. That'll fill some of the jobs,
yes,
and not all of them. But we do need targeted migration, and that's certainly going to be the case for certainly at least the next 5 or 6 years.
Well, actually, maybe more than that, because the aged care industry is more and more. 80 people over 85 are going to be living longer and needing to go to nursing homes, and there just isn't the people to look after them or provide for them.
That's right. No, I don't know about you, but I don't want a robot taking me to the bathroom.
No.
It's going to be a human. It's
Never
going to
thought
be
about
a
that.
human
So
being.
this is some thoughts from ID demographers who advise governments, and they're suggesting that in the next decade, our population is going to grow by about 3.9 million people. So over the next 10 years, there's going to be consistent, strong population growth. And this is not at the 500,000 people a year, but as I said, in the next 3 years, we're going to have another million people. By the way, they're going to need cars on the road, and they're going to need to buy a whole lot of goods and services. So that's going to be good for our economy. We're going to, in the next decade, according to the demographers, create 2.6 million new jobs. So employment's expected to grow. Some of the jobs will be different to what they were before. But interestingly, many of them are going to be skill level 1 and 2, knowledge-based type jobs. So the average income is going to increase. And to me, Ken, this is going to underpin the value of our property markets. So the topic of today was, is this a crisis or an opportunity? Now, we're not wanting to belittle or downplay the challenges first home buyers have, or tenants who are having difficulty paying the rent. It's terrible to see in Australia the situation that there are 10 cities that, you used to see in the movies in Los Angeles and the slums. This should not be happening in this beautiful country we live in. But what I guess I'm saying is that if you believe that the population is going to keep growing and that we're going to remain a wealthy nation, that's only going to underpin property values, Ken.
That's right. It's that supply and demand side of things. So people are going to come where there's jobs. If they're high-paying jobs, they're going to pay more for rent. They're going to pay more for a property. People will build in those areas, will want to live in those areas. And if land is restricted, if you like, then the existing stock, the existing properties in those areas will grow disproportionately upwards.
Definitely. One of the challenges, though, is that there's not enough public housing. We're talking in general about rental accommodation for people who choose to rent. Now, some can't afford to buy. We know a lot of people choose to rent at the moment because they're just the lifestyle stage they're at the moment. But the government has outsourced that to private investors, people who run small businesses like you and me, providing rental property accommodation for Australians. But I believe it's the government's responsibility, Ken, to provide public housing, because there's always going to be socially disenfranchised people, people who have health problems, welfare problems, and that's what public housing should be. Having said that, this shows the huge decrease in social housing stock. The government is having to close some down. They were built 70, 80 years ago. So these are accommodation funded partly by the government, sometimes managed by the government, sometimes managed by community organisations, including Indigenous organisations. But they're just not keeping up their share of that. And that is a real shame in this country, Ken.
It is. And if we look at that chart 4.7 that you've got, social housing stock as a share of housing stock, in the 70s, the late 60s, 1970, that number was 10%. So 10% of housing stock was social housing. And that's gone down to, those levels of 3%. And it's unsustainable, because that means if governments aren't building properties, that means the private sector has to take over, and the private sector has to make a return. Why else would they take the risk? Sure. And if there's not many properties being built, that's pushing up rental, which is then a spiral that is getting worse and worse and worse. When you see lines of 10, 20, 30, 40 people, I saw one the other day, a line of 40-odd people waiting to inspect a rental property.
Well, of course, that's what I was saying a moment ago about 10 cities, because that tends to, in general, be the more disenfranchise people, which I believe is our responsibility, the government's responsibility. That's why I'm happy to pay taxes to provide for the police and for the hospitals and the roads and these sort of things. I was going to say to provide for the politicians, but not really. So in the budget, the government offered an extra $1 billion to states and territories for housing support programs. Ken, that sounds like a lot, but when you actually divide it amongst various states and then work out how much each accommodation is, it's only really a blip in the ocean. And it's also had $1.9 billion to increase Commonwealth rent assistance by 10%. That's not going to catch up. It's not going to make a difference. You mentioned a while ago about the new TAFE places. The government is offering 20,000 new fee-free TAFE places. Well done. Yeah. We actually have to train apprentices. But having said that, that's going to be 3-4 years before anything happens. Again, I keep coming back to there's no end in sight for these challenges at the moment. Now, Ken, part of the reason you and I said let's have this chat with the people, and thank you very much for those of you who are staying on. Is this interesting information? Do you mind just putting in the chat if you find this useful, if this is actually helping you? Because what we've done up to now is talk about the position of what's happening. I'd like in a moment for the next little while to explain a few other things, and then we're going to tell you how to take advantage of the opportunities, not of the people, not of those who are having trouble, but to set yourself up. Please just say yes, it's of interest. I guess it is, because in fact the numbers are staying here very high in this. What I'd like to point out is that we thank you, Robert. Thanks, Rowan, John Lyle. I'm glad that you actually managed to get on, and because I know you had some troubles initially. We keep hearing that investors are leaving the property market, and we're seeing that a little bit at Metropole with landlords. But fortunately, it's not because they've had financial troubles, in my mind, because most of them have been set up with correct structures and correct budgets and correct properties. But this is an example of what's happened in, this is thanks to MCG Quantity Surveyors, our friend Mike Mortlock there. And it was last month, the number of properties in Melbourne currently for sale and certain suburbs. Now, some of you who are not from Victoria would not recognise that the suburbs where there's lots of properties for sale are in general the poorer outer new homeowner suburbs, the lower socioeconomic suburbs. There was lots of new house and land development packages put in Werribee and Point Cook and Tarneet. Sure, there's some inner suburban areas as well where a lot of them were apartments. But interestingly, there are more and more properties being sold that were on the rental market. And what they did was they looked at all the properties for sale, and then they looked on the domains to see were they in the past on the rental market, and that's how they worked it out. In regional Australia, Victoria, there were lots of properties as well. And this is an interesting trend showing that the number of loans for investors in Victoria is trending downwards. So there are fewer and fewer people taking loans to invest in Victoria. And we can talk a bit about why in a moment. In Sydney, similarly, when you look at the suburbs in general, they were in some of the inner suburban apartment areas, but also in the poorer outer suburbs, and much the same in regional New South Wales. Interestingly, the trend for investor loans in New South Wales is trending upwards a little bit, even though things are a little bit more expensive. Jane Roberts said holding costs in Victoria have increased. That's why. Correct, Jane. I think it's a number of factors. Holding costs have gone up. There's also been the lack of confidence when the government treats us as an ATM as property investors in Victoria. Extra land taxes, extra compliance costs, more changes again. So you're right, Jane, that's the case. Much the same in Brisbane, not as many in Brisbane for sale at the moment, and investors are really running to the Sunshine State at the moment. This is showing how many property investors are currently in Australia, sourced by data from the Australian Taxation Office. If you go back a decade or two, you'll see Every year, there were 60, 70, 80,000 new investors coming into the market. Every year, some leave, some come into the market. Over COVID, there was very few came into the market, more left. But the last couple of years, it's been 18, 19, 20,000 new investors, extra investors. There's actually fewer investors coming into the market. And if you look at what they end up doing, we know, and these are tax office statistics, the latest ones, and it shows that, well, we know that 50% of those who get into the property investment field sell up in the first 5 years. In fact, the latest CoreLogic data suggests that they don't even many don't last 5 years. 71.48% of all investors only own one property. 92% of investors never get past their first or second property. Interestingly, of all the taxable units in Australia, and that's what the tax office calls them, so it's companies, trusts, super funds, there's 19,920, 20,000 investors own 6 or more investment properties. Of the 2 million property investors, 1%. Less than 1% own 6 or more properties. Interestingly, a recent audit of the results of the clients at Metropole showed that our clients were 7.3 times more likely to own 6 or more properties than the average property investor. They make the right decisions because they've been given the right advice. And so therefore, we help our clients, our team, start by putting a strategic plan together, and then we actually help you implement that plan to safely outperform the markets and grow into generational wealth. And we do that by using frameworks that I've fine-tuned over 5 decades, and we've been helping clients with for over 26 years. And the clients get access to Ken and his team to look at setting up the right structures. None of this is personal financial advice. I should have given the disclaimer at the beginning. And while Ken is an accountant and got financial planning qualifications, and we've got Metropole Financial Planning, this is definitely not financial planning advice, but we can help our clients with that. And then we manage their properties. And one of our areas of expertise is doing small development projects and construction to help our clients become armchair developers. Now, the question Stephen asked was that ATO consolidated ownership. Most people have a mix of personal ownership trusts. You're 100% right, Stephen. So what that slide showed was taxable units. I have multiple taxable units, lots of different trusts, as does Ken. So it's actually fewer than that, the number of investors in that field, Ken.
That's right. So, I tend to only have one property per trust. So I'd be counted in, I've only got one property. But the number of, anecdotally, the number of people who only own one property is at that 70 plus level, because it's the teachers, it's the fire, it's the police, it's all those people who are really starting to have an impact, because they know that their future retirement can't be solely resting on superannuation. So they're looking at alternative fields of income to support them in the future.
Sure. So the question people are wondering, because they're exiting, is the party over? Is this the end of it? Should I even bother with all this? Well, again, Ken and I have been investing for, we're similar ages, such a long time that we've been through those stages in the cycle as well, Ken, thinking, we've heard, I don't remember anything in the 70s, even though it probably was there, but definitely in the 80s, people said, prices can't go up anymore. Our children will never get in the market. That's it. Prices can't go up.
And you hear that over and over again. And, from 250, is it going to get to 500? Is it going to get to $1 million? We're now starting to talk in Sydney. When are we going to get to $2 million as a medium house price? Which, and even when Metropole opened up its Sydney office, when you look at the properties that we were buying 10 years ago for 400,000.
When we did open up in 2008, we could buy properties in the inner west for 250, less than 300,000 apartments in the inner west. Now, good friend Stuart Weems from Pro Solution Private Clients has shown this chart to just remind us that the property market moves in cycles, and there are periods of strong growth, periods of no growth, periods when the properties go back a little bit, but the long-term trend is up. So I wouldn't be worried as much about the short-term trends as long as there's no big change in the fundamentals. So what does the future hold? I believe that demographics are going to dictate what's going to happen in our property markets. I believe over the long term, our growing population plus the fact that millennials are at household formation age, baby boomers have only got 1 or 2 people households, that's going to make a big difference on what's driving our housing markets. I believe Australia is going to continue growing despite what the government and the opposition is saying in an election year. They can't stop immigration. Australia's economy will keep growing. It's fumbling along. It didn't grow much in the last early quarter of this year, did it, Ken? The figures that just recently came out. But that's because we're being shackled at the moment by the high interest rates. When inflation's under control, the economy will pick up again, Ken.
Yeah, and I think a lot of people are in deep shock. What's going to happen next? You know, the governor of the Reserve Bank just the last few days, is saying that inflation is sticky, and she's saying that's the bane of households. High inflation is what's strangling households. So they're going to do anything to keep it down.
I think the work from home revolution isn't going to go away, so the sort of accommodation we require is not going to disappear. We've talked about the changing trends of baby boomers and millennials moving to the next stage of their lifestyle, driving the type of property that will be in continuous strong demand. The workforce is changing, and that's why we need more immigrants, but there's more high-level, skill-level, knowledge-based jobs and more people without skilled jobs, and the middle-class Australian is definitely missing. So I believe to take advantage of these future opportunities, you can't just buy any property. You need to start with a plan. You've got a plan for become the people you plan to become. And then, unfortunately, you've got to plan for your plan not to go to plan, because every year there are some unknowns happening. But we at Metropole always start with a plan, and then we help you implement that, because the property you eventually buy will be the physical manifestation of a whole lot of decisions you have to make, and you've got to make them in the right order. So buying a property is not a plan. Buying an investment is a process, not an event. But when people come to see us, Kim, the common thing they ask is, how much are your fees, or where should I buy? And in my mind, that's a shallow conversation. What you need to understand is, where are you now? What are you wanting to achieve? Because the sort of investments that Ken and I make at our stage of life are very different to what we made 20, 30 years ago, and very different to what we made when we first started investing. So it's got to be where it fits in your stage and game of life. So our strategic plans have multiple factors: asset accumulation stage, a manufacturing capital growth strategy, which is part of the development and renovation process, a rental growth strategy, critically protecting yourself with asset protection and legal tax minimisation strategies, which Ken and the team at Metropole Wealth Advisory specialise in, a finance strategy. Our clients don't just buy properties, they buy time to see them through the ups and downs, and then eventually a living off your property portfolio strategy. I know, Ken, what you're very busy doing at the moment is helping we help a lot of beginning investors, and many of our investors are still at the growth stage of their portfolio. You're helping a lot of people transition to their silver years, their golden years. I'm not sure which has come first. I think you get silver before gold. I can't remember. To be able to live off their portfolio, because they need a different set of advice at that stage, Ken.
A different set of advice. So it's really that transitioning. It's that pathway from asset accumulation to living off that passive income. And for a lot of people, they either don't make the decisions 20 years before to grow their assets, or they're at the other end of their life and they're asset rich, cash flow poor, and don't know what to do next. And they either sell everything and again make the wrong decisions. So we need a plan to take you through, because if you retire at 60, 65, whatever the number is, if you're reasonably healthy, you're going to live to 90 plus. So that means you've got another third of your life to go.
Jacqueline, thank you for your comment. No, it's not too late starting in the mid-30s. You've got a really long runway, and that's good. But not every property is a good investment, so you've got to get it right. So therefore, I guess you can see, are much more than just another buyer's agency. We help our clients safely grow intergenerational wealth through strategic property and wealth advice by putting a strategy together and then helping them implement it. So my suggestion is to outperform these markets, because I see it as a glass half full opportunity, not a glass half empty. Yeah. Play the long game. Ken has said that a few times. Have faith that the fundamentals in Australia are not going to change. Again, I believe demographics are going to drive the market, but you should only buy quality assets, because what you're buying now should see you through until, for the next, 20, 30 years until you retire, and then another 30, 40 years, as Ken said, and then you're probably going to want to pass them on to your kids. So you don't want to give them things that are not going to properties, assets that are not investment grade, good quality assets. And this is a good stage in the cycle to manufacture capital growth by getting involved in small property developments. Now, you may say, I know nothing about property development. Well, I do, and our team does, and we help beginning investors get involved in the wholesale end of the market by becoming armchair developers. But I wouldn't suggest you just time the market or try and time it. That's a silly thing to do, because in fact you missed the bottom. The bottom was 18 months ago, and we were telling people at the beginning of end of 2022 that this was happening in my regular weekly videos with Dr. Andrew Wilson. But you've got to have a plan, because that's going to stop you making emotional decisions. And our strategic plans, we use very, very powerful software to give you a whole lot of information. This is just a little bit of what clients get. So you've got access to this. So while we put the plan together for you and work out where you can be, and then you actually, if you're an analytical person, you'd love all the numbers and the what ifs and what you can do. And we put in when you could buy properties, because there's not one way of getting there. So we've got to find the optimum way of getting there. So a very powerful software. You can see where your equity position is out to 30 years, what your income positions are, what if we bought a property, if we sold a property, if you bought it in your SMSF, if you paid off your offset account, all sorts of things. So that's the sort of detail you need to get going, and then we'd start to implement the plan. Now, we're going to answer some questions in a moment, but one of the interesting things I didn't do at the beginning of this masterclass was what most people do and told you to turn off your phones. Well, I'm telling you to pull out your phones and scan this. And I'm going to suggest you scan this and make an appointment to have an obligation-free wealth discovery chat with one of our wealth strategists. Just click on this link now there. You can go to workwithmetropole.com.au, but scan this and then make a time, and one of our team will have a chat with you. No cost, no obligation, to find out where you are, explain to you a bit about what this powerful software could do for you, how it could help you, where we can help you. I don't know if we can, but we've got a full range of services. We help home buyers, we help beginning investors, and Ken and his team particularly love helping clients build their long-term future through owning the right asset structures. So what's ahead? Well, I think the economic fundamentals are going to remain very strong. So I think interest rates are going to remain higher for longer than most people would like. They probably aren't going to come down till end of this year, early next year. I think borrowing capacity is still therefore going to be restrained for a while, but eventually interest rates will fall, and eventually APRA is going to loosen the screws. And when that happens and financial serviceability is easier, the hordes are going to get back into the market. And then you're going to have a lot more competition. So if you've got a secure job and you're financially able to, this creates a significant window of opportunity now where you can get in before the competition is strong. I believe population growth is going to remain high, and there's no end in sight for our housing shortage. Which means house prices are going to keep increasing, but not at the same rate everywhere. Rents are going to keep rising. Unfortunately, more Australians are going to rent for longer for the reasons we've said, but our markets are going to be fragmented. The rich property owners can, and those who can pass on to their kids, are going to get richer, and those who are not in property are not. Now, some of you may be thinking, hey, that's not fair. It's the way it is, but that doesn't mean you shouldn't get in, because over the last decade, there have been 1 million new first home buyers in the market, and you can outperform the averages by choosing the right properties and manufacturing your own capital growth. This is what Oxford Economics believes is going to happen. They used to be called BIS shrapnel. It's actually similar forecasts to what our team are thinking and similar to what Dr. Andrew Wilson, who we work closely with, believes. So that overall, the big capital cities, if you look over 3 years, are going to have 20 to 30% price growth over the next little while overall. And that's median growth or average growth. So there's going to be some areas that outperform and others aren't. So therefore, strong fundamentals, undersupply will lead to considerable capital growth moving forward in many of our capital cities. So I play the long game. I think I've actually shown these slides before.
Yeah, so no, we don't need to do that again. I think that's the issue, Michael, that number 4, buy quality assets. I mean, in a rising market, you can sell anything, even if it's at a little bit down. But a good investment grade property, you should be able to sell at any time during any cycle.
Or lease at any time.
Or lease it at any time. So to me, that focus, that number 4 that's really the make or break. Buy high grade properties that will outperform the market in both capital growth and rental.
Now, we've reached the hour, but I am going to answer a couple of questions. But if you want to work with us, then please don't hesitate to scan that. But I am actually going to go back and have a quick look at some of the questions, because Guy and Fernando asked, what are the best suburbs in Brisbane, Perth and Adelaide? Well, how did we decide Brisbane, Perth and Adelaide are even the best places to invest? And then what is your budget? And in every suburb, there are areas where we would invest, areas where we wouldn't. So it actually doesn't work as simply as that. With all due respect, you're starting with the property. That's the wrong end. The property's got to come after you've done a plan. So I don't know what your plan is. I don't know. Are you looking for cash flow? Are you looking for capital growth? Do you need a combination of both to have serviceability? And that will make a big, big difference. So I understand why you're asking suburbs. That's what most people do. But if you remember, most people sell up in the first 5 years, and most investors never get past their first or second property. So on that basis, you've got to think differently to how the average investor does things and do things differently how they do. Lynn said many people consider units until they own or realise the nightmare of owning a unit is. The government needs to sort this out ASAP. I own a number of blocks of apartments. I know Ken owns units as well. You've got to be careful. So if we talk about apartments and we help our clients with apartments, Lynn, we don't buy the new or the high-rise ones or the ones built over the last 15 or 20 years. They were built out of paper mache. They've got a lot of problems. They've got strata problems. Almost every building in Sydney's got water problems. Melbourne's got cladding problems. We like the older, what I would call family-friendly, established apartments, Art Deco apartments, ones with balconies, ones with courtyards. So not all units do have problems, but I definitely agree that many do. So you've got to be very, very careful. Scott Smedley asked, Ken, do you think shared equity arrangements will become more popular to help younger people get into the market? The government is interested in or prepared to be your business partner on certain criteria to help you get in with about a 5% deposit, Ken?
Look, I think there's the two things. There's first home buyers, there's superannuation accounts you can set up. There's the 5%, there's stamp duty concessions. I think that's one group, but they don't own part of the property. There's another group where the bank might say, we will give you 20%, but we will own 20% of that property. So that, I think, is going to be fraught with danger in a couple of years' time, 10, 15 years' time, when people say, well, I'm going to buy that bank out. Oh, they bought in at 200,000. I now have to give them $1 million. I've got to go and borrow that money. And how can I? The one that I think is the most dangerous, the one that's got the more clouds, is, can I say, when friends get together and pool their funds?
Yeah.
Because circumstances change more than the property market changes. People get married, people get divorced, some people might need medical assistance. Everyone's borrowing capacity changes. People's reason for holding the property will change. So if you do that, you need a very robust exit strategy of how do people come in and how do they go out and how's it going to be funded. But I think that's if I can use the word dangerous, that's the most dangerous form to me of joint ownership.
Jennifer Matheson said, useful background information. Thank you, Jennifer. Looking to hear more about what you think retirees who've got reasonable super income accounts to invest in houses rather than keeping that much in super. Jennifer, we cannot give you superannuation advice. That is a financial planning product. Ken and his team can see you individually, personally. If you want to scan that and make a time and say when you make your inquiry that you want to speak with Wealth about Super, Metropole Wealth Advisory about Super, because I believe your question is, should we invest in a home, a house or real estate which has leverage, or should you invest in other asset classes in your superannuation? Again, everyone's circumstances are different. The problem at the moment is that there's people out there giving advice to ordinary Australians about what they should do in their superannuation when they're not licensed to, they're not right to be able to do that. They're encouraging them to set up self-managed super funds and buy properties because they're marketers representing developers. We've seen a lot of people end up with significant problems with that, Ken. So we unfortunately, Jenny, we can't Jennifer, I hope you don't mind me calling you Jenny. We can't discuss that in this forum, but definitely can one-on-one if that's your situation.
We certainly can. I mean, supers, and to buy a property in your super fund, I can say you've got to have a self-managed super fund. You can't go to Hester or whatever and say, buy me 15 Smith Street. So the self-managed super fund has to be right for you. It's got to have the right investment strategy where property may be appropriate. There's then lots of pitfalls and avoidable errors that I see literally every day people making. And that ends up costing them tens and tens of thousands, if not a lot more than that, if you do it wrong. So is it appropriate? For some people it is, for others it's not. That's why I think you need a one-on-one.
Now, Carla asked the common question, is it ever worth targeting yield over capital growth when you don't have spare financial capacity to target a high growth asset? Carla, I don't know what stage of your investment journey you are, but the first stage of the investment journey is building your asset base. You will then eventually get capital growth. If you buy a low growth, high yield property, then you're going to most likely get stuck at one or two properties because the rent's servicing the debt, but you'll never get the deposit for the next one. You'll never get the asset growth to give you the equity and the rental income growth, which goes up as the asset goes up, to be able to get the serviceability for your next loan. So is there time to move to yield over capital growth? Definitely, but we believe it's the other way around. Once you've actually got yourself a substantial asset base, then you eventually have to lower your loan to value ratio so that you can move into the next stage of your investment journey. The trouble is, property investment is expensive. Not everyone can be a property investor. And I understand, Carla, that you may currently have challenges, but maybe buying in Melbourne, Sydney, Brisbane isn't the right area for you. I'd rather you buy a first-class growth property in a big regional area than the wrong property at the beginning of your journey, because you're not going to get to the next stage. John Lyle asked, what's a quality asset? Now, guys, you're probably on this webinar because you get my property update. So if you look on propertyupdate.com.au and do a search on investment grade property, we'll give you a lot of detail. Too late in this webinar to explain that to you, John. The fact that you're not sure, and I don't know what level of investment you are, means that you've got to be very careful on whose advice you listen to, because most people are there selling property. I hope you've by now found that Metropole has no properties for sale, if we have access to every property on the market. And our recent estimate would suggest probably about 4% of all the properties on the market currently are what we'd call investment grade. So therefore, I'd be very cautious with that. What's our opinion on rent vesting, Alexander? I actually like the concept of renting where you live, where you want to live but can't afford to buy, and investing elsewhere. The problem is you've got to plan it out, because down the track, you may not be able to buy the house that you want to buy if you go down that route. So it's very hard to, if you want to buy the next 3 to 5 years, to do that if you start reinvesting. Big assumption, but that's why we do these strategic plans where you can do the numbers and figures and actually make your decisions based on evidence. So again, if you do that scan and have a chat with we've got a couple of pretty faces there on the, and I'm talking about Ken and me are the pretty faces on the slide there, but we've got a substantial team to be able to help you understand whether rent vesting would work for you. It definitely is appropriate for a lot of people. You've just got to understand what your next steps are and what your time frame are.
Just on that, Michael, there's also a hybrid model to that, given the different tax implications of living in your own home versus renting a property. We have been working with quite a number of clients with a hybrid model. On that very point, it might be too expensive in 5 years' time to buy the house you want. So how can you structure it maybe to get the best of both worlds?
Well, I don't own the home I'm living in at the moment. I've been a rent investor all my life, but a company very closely associated with me is a very nice landlord. Joseph asked 2 more questions and we're going to finish up. Guys, thank you for giving us the courtesy of allowing to stay on a little bit longer. With the government wanting to build 1.2 million homes due to the cost pressures, is there a chance these are going to be low-cost towers similar to housing projects elsewhere? Well, the government's not building them. The government is wanting private investors and developers to do that. Private developers are going to do it in one of 2 ways. The build to rent accommodation, and that means they're going to keep them in the long term and rent them out. And they're only going to do this, the superannuation funds and the overseas corporations, if they can make money out of it, because basically they've got to make money for their shareholders. And so if there's better asset classes, they'll invest there instead. I'm not comfortable the government's giving them incentives from your and my money to do it. I'd rather give you and me the incentives to do this. But I don't think they're going to be cheap, affordable towers anymore. In New South Wales, there's a building commissioner who's going to make sure all new construction occurs properly. Again, that is the risk of that. No argument. So be wary of unintended consequences from government actions. And Scott says, how will APRA loosen the screws? The answer is, at the moment, there's a 3% serviceability buffer. If you go to the bank and the interest rates are making up 6%, they're going to make sure you can service the loan at 9%, 3% above the current interest rate, Scott, because that was appropriate 3 years ago when interest rates were very low. It's not as appropriate now, so they're very likely going to drop it to where it was a couple of years ago. And Ken, what will be the last question from Andrew? What will happen to the house market in a worst case scenario?
I think the first question I'd be asking is, how long will that worst case scenario last? And we've had bad scenarios that have lasted 2 or 3 years. So you've got to be able to do 2 things. You've got to be able to fund your way through that process. So have you set up your finance correctly? Have you bought it in the right structure? All those things. The second thing, which is, I think, even more critical, is the better property you own, the easier it's going to be to sell with the smallest amount of discount. So if you've got to get out in a hurry, I'd rather be trying to sell a exceptional property into that market than a poor property.
So therefore, when we help our clients, we help them buy time as well as properties to see them through. But the interesting thing is there has never been a property market crash in Australia. There has been a downturn, no argument, and there always will be downturns. I'm not suggesting property values go up all the time, but the biggest one was about 9-10% a couple of years ago, 5-6% the cycle before. So people have to live somewhere. Investors will sell up, but in general, homeowners will rather eat Maggi noodles or dog food than sell up their homes. So you need a major recession where people are losing their jobs and can't keep their mortgages up. And when that happened in the past, the banks helped out, didn't they, Ken? They didn't want to become mortgagees in possession.
That's it. And the landlords were forced to help. So in COVID, you were allowed to tell your landlord, I want $100 a week rental reduction, and you couldn't even question it. The banks extended the terms of the loans from 25 years to 30 years. They made them interest only. And the banks, I think today, are not the banks that were there in the Depression, where people got their house sold from under them. But the lesson we've learned is, if you are in that precarious position, go to your lender, which is the bank, ASAP. And if you go to them quickly, they will help you. You don't wait till you've had your 5th, 10th demand and there's the sheriff knocking at the door.
Well, Ken, thank you very much. For all the hundreds of people who've remained online, thank you again so much. It's actually taken a little bit longer, but I appreciate your questions. We will be doing these regularly. You're going to hear Ken and me on the Michael Yardney podcast and on our videos. So if you would like to be one of those who takes advantage of the opportunities the market's currently offering, why not have the team at Metropole on your side? It's a great feeling having the comfort of our experience there. Look forward to speaking with you again at the next upcoming webinar real soon, Ken. Thank you very much.
Thanks, Michael. Thanks to all out there.
Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?